You open a spreadsheet, pour a coffee, and type the question everyone asks at least once. Which states have no income tax? And is it actually worth moving? The internet will happily answer the first half. The second half is real life. Your W-2, your business structure, your family, your mortgage rate, your appetite for hurricanes or wildfires, and the single concept that decides your fate in any state: residency. Let's make this decision calm and arithmetic. Start with the map everyone quotes. As of today, 9 states do not tax personal wage or salary income: Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, Wyoming, and New Hampshire. New Hampshire's tax on interest and dividends is gone, so it's clean on wages and investment income. 2 caveats keep you honest. Washington imposes a capital gains excise on certain large sales of capital assets above a threshold. And no income tax never means no taxes. These states fund themselves through other levers: sales and use taxes, property taxes, gross receipts or franchise taxes on businesses, fuel and lodging taxes, and a forest of fees that feel like taxes when you pay them. Florida is the poster child for remote workers. No personal income tax, generous homestead protections, and assessment caps that soften long-term property tax increases once you plant roots. The flip side is insurance. Premiums have climbed in hurricane-exposed regions, and a home near the water can need a 5-figure annual insurance budget just to sleep well. Sales tax is middle of the pack. Property taxes vary by county, and there's no state, estate, or inheritance tax. Retirees enjoy the simplicity. The state doesn't tax Social Security or retirement withdrawals because it doesn't tax income at all. Texas looks similar at first glance. No personal income tax, but very real property taxes, and a franchise tax on businesses called the margin tax. A homeowner's annual bill can rival a car payment every month, so you budget for the full load, not the listing price. In return, you get a diversified economy, no state, estate, or inheritance tax, and deep labor markets for almost any profession. Tennessee has finished phasing out its old tax on interest and dividends. That's a quiet victory for investors and creators with portfolio income. Day-to-day life includes one of the higher combined sales tax rates in the country, so consumption is where the state collects. If you're a big spender on gear, furniture, or frequent dining, some of your income tax savings will be given back at the register. Nevada mixes no income tax with a tourism-heavy economy. For businesses, there's a commerce tax on large gross receipts above a threshold. For households, sales and property taxes are the levers you'll actually feel, and homeowners often find the total burden modest compared with coastal states that have income taxes. Nevada is famous for friendly entity rules, but remember, forming an LLC there doesn't magically shift where you're personally taxed. Your personal tax follows where you live and work. Wyoming and South Dakota appear in wealth planning conversations for good reasons: no income tax, comparatively low property taxes, and reputations for stable administration. If your life and business already tilt west and you value quiet predictability, these states can be compelling. If your clients, teams, and airports are elsewhere, the friction of distance may outweigh the savings. Alaska is the purest version of no income tax. In some municipalities, there isn't even a local sales tax. But geography and climate are part of the price. The state leans on resource revenue and local sales taxes in many areas, so the budget doesn't fund itself on vibes. If you want dramatic scenery and can handle logistics, Alaska can be financially clean and personally rewarding. Washington is the outlier that proves the rule. No tax on wages, but a statewide capital gains excise on certain sales above a threshold. If your plan includes selling a big stock position or a business interest, you model that number before you fall in love with Mount Rainier. On the business side, Washington uses a gross receipts tax called B&O, even low-margin businesses pay, which can bite if you sell physical goods or run an agency with large pass-through spend. New Hampshire now lands with a tidy 0 on wages and investment income, but property taxes are among the highest in the country. Your quarterly bill will remind you that no income tax isn't a free lunch, so you price homes with the annual levy in mind. So is it worth moving? It depends on what you earn, how you earn it, what you spend, and where your life wants to be. If you're a W-2 employee making mid-6 figures in a high-tax state and your cost of living is flexible, moving to a no-income tax state can add real after-tax dollars every year. 2 facts bend every model. High-tax states are good at not letting you go, and savings vanish if property taxes, insurance, and lifestyle creep reabsorb them. To leave cleanly, you have to win the residency game. States look at 2 ideas: domicile and statutory residence. Domicile is your true home, the place you intend to return to when you travel. You prove it with actions: where your primary home sits, where your family lives, where your keepsakes are, where you vote, where your driver's license and professional licenses live, where your doctors, clubs, bank branches, and pet records are. You change domicile by changing your life, not by filing a form and keeping your old place as a casual crash pad. Statutory residence is the trap for commuters and frequent flyers. A classic example is New York's two-part test. Spend 183 days or more in the state and maintain a permanent place of abode there, and you can be treated as a resident for tax, even if your heart swears it moved to Florida. Other states have their own versions, but the theme is the same. A day counter plus an available home equals a tax bill. If you want clean separation, you reduce your days and cut the available home link by selling, renting long-term, or otherwise making it unavailable to you. Remote work adds its own wrinkle. A handful of states apply a convenience of the employer rule, taxing your wages as if you worked there when your employer is based there, even if you now sit in a sunnier zip code, unless the employer assigns you out of state for its necessity, not your preference. The fix is structural. Have HR repaper your office of assignment to a non-convenient state location or hire you through a subsidiary there. Without that, you can move your furniture and still owe your old state. Business owners face different levers. No income tax states still tax businesses, just with other instruments. Texas's franchise tax applies above certain revenue levels. Washington's B&O is on gross receipts and ignores your margins. Nevada's commerce tax clicks on for large businesses. Tennessee has franchise and excise taxes on entities, even though it doesn't tax personal investment income anymore. If your strategy is, move my LLC to Nevada to avoid California, remember that California taxes businesses doing business in California, regardless of where the LLC was formed. Nexus follows people, property, and markets. Paperwork alone doesn't beat substance. When does the move pay? Picture a W-2 designer earning $250,000 in a high-tax coastal state, renting, fully remote. Moving to Florida or Texas with similar pay and reasonable rent typically nets 5 figures after tax, every year. Buying a home doesn't break the logic, but you make sure the property tax bill doesn't swallow half the savings. For investors with large dividends, moving to a no-income tax state can be even more valuable because portfolio income escapes state tax too. If you're planning a one-time sale of a large position, Washington's capital gains excise complicates the no-tax story. Florida, Texas, and the other 7 without such a tax may be cleaner. For a small business with low margins, you run the math line by line. A gross receipts tax in your new state can out-collect an income tax in your old one if your margins are thin and your top line is high. In that case, Wyoming or South Dakota can be friendlier than Washington, and Florida or Texas can still work if you manage your franchise tax base. But you won't guess your way there, you'll model it. Families have a different calculus. Property taxes in Texas, New Hampshire, and some Florida counties can be hefty. Schools, insurance, and commuting are real costs. If your kids thrive where they are and your partner's job is anchored in the old state, the soft costs can exceed any tax savings. If you're empty nest and truly remote, flexibility becomes your superpower, and a decade of tax savings looks like investment, not lifestyle frosting. There's also the one-time versus always question. If your windfall is a single liquidity event, a startup exit, a fund distribution, a concentrated stock sale, you plan the calendar with a map in one hand and a residency checklist in the other. You move early enough to pass your new state's tests. You sell only after you're clearly domiciled and out of your old state's statutory resident net. You do not commute back and pile up days with a condo still in your name. You harvest the savings once and then decide whether to stay for lifestyle or rotate back. If your savings rely on annual wage or dividend differences, you're choosing an ongoing life, not a tax weekend. Execution is where most plans succeed or fail. You lease or buy your new primary home. You sell the old one or rent it on a true long-term basis that makes it unavailable to you. You move your family, your pets, and your heirlooms. You change your driver's license, voter and car registrations, professional licenses, bank branch, doctors, and the mailing address on every important account. You join local institutions and actually live there. You track days like an athlete tracks workouts. If you must spend time in your old state, you log it and keep it below the bright lines. You switch your employer record to the new state and, where needed, change your assigned office to avoid convenience rule tangles. You file a clean part-year return in the year you leave and a non-resident return thereafter, only if you still have source income in the old state, like rent from a property you kept. You keep a one-page memo to future you that explains in plain words when you moved, what you sold, what you kept, and where your life points now. Sales tax is the quiet variable. Tennessee, Washington, and Nevada have higher combined rates. Florida and Texas sit in the middle, but can feel high in tourist zones. If you're furnishing a house and buying a car, your first year's sales tax spend will be noticeable. The long-run antidote is boring. Spend less than you make and invest the tax savings instead of upgrading everything by the same amount. Property tax is the other anchor. In Texas and New Hampshire, you project your annual bill before you make an offer. In Florida, you learn how the assessment cap works after you claim homestead, and you watch how a prior owner's capped value resets when you buy. In Nevada and Tennessee, you compare county by county. In Wyoming and South Dakota, the line item is often pleasantly small, which is why those states feature in long-term plans for families who intend to stay put. Estate and inheritance taxes can swing decisions at higher wealth levels. Washington has a state estate tax. Most of the other no-income tax states do not. If you're thinking in multi-generational terms, that single line can matter more than a point or two of sales tax, especially if your wealth is concentrated in a closely held business or appreciated securities. Insurance is not a footnote. In Florida and parts of Texas, homeowners' premiums and wind coverage reshape budgets. In wildfire-prone regions of several no-tax states, carriers and rates are evolving. Before you pack, get quotes based on the exact address and construction type. A low state tax rate does not fix a roof. If you own a business, you align payroll, unemployment insurance, and workers' comp with your new state. And you consider whether any of the pass-through entity tax elections in income tax states still matter to you. In a no-income tax state, they usually don't. What matters instead is where your employees and contractors sit. They create tax and regulatory obligations for you in their states. We're a Texas company is a brand line, not a shield if your team is scattered. You keep a folder with your deed or lease, moving receipts, utility start dates, voter card, driver's license, school records, club memberships, and a clean day log for the year you left. If a revenue agent ever asks why you left state A for state B, you don't perform a poem, you show a timeline. Facts eat paperwork for breakfast, and good paperwork is just organized facts. Close the spreadsheet and finish the coffee. The map is no longer a cartoon of free states and expensive states. It's a set of trade-offs you can price. No tax on wages here, but higher sales tax there. Friendly homestead rules here, but a business gross receipts tax there. Perfect winter sun here, but insurance that needs a grown-up budget. If you choose to move, you won't be chasing a meme. You'll be executing a plan. If you choose to stay, you'll do it with open eyes and a few smart tweaks. Bonuses times differently, equity sold on a different calendar, travel days that keep you clear of statutory traps. The headline is simple. 9 states don't tax your wages. Whether that's a life upgrade depends on your life. Treat the decision like a spreadsheet and a story. Numbers you can add, facts you can prove, and you'll get the only result that matters. A home that fits, a tax bill you expect, and a life you don't have to over-explain to an auditor or to yourself.